Usually when you get into a car with self-driving features, there is this underlying expectation of relaxation.
Oh, absolutely.
Right. Like you tap a button, the system takes over, and the machine just points itself down the highway. It essentially whispers, don't worry, I've got this.
Yeah, you can just take your hands off the wheel.
Exactly. You maybe look out the window and you just trust the engineering.
The appeal is massive, honestly. I mean, we inherently want to believe the technology is just perfectly in control of all those variables.
But then, imagine actually scaling up those stakes. Imagine that this isn't just your personal car on a quiet Sunday.
Right.
You are driving a massive double-decker bus down a mountain road, and in the back are the life savings and retirement funds of millions of everyday people.
It changes everything.
We are talking billions of dollars here. Suddenly, trusting a black box algorithmic robot to drive doesn't feel relaxing at all. It feels completely terrifying.
It really does.
The trust issue becomes literally the only issue that matters.
Fiduciary responsibility enters the chat, as they say.
Yeah.
Because when you are managing institutional wealth, you are legally obligated to act in the best interest of the beneficiaries, handing over the steering wheel to a system whose decision-making process you don't fully understand. That is the absolute definition of fiduciary muddy waters.
Which brings us to our mission for you today. Welcome to this deep dive. Today, we are exploring a really compelling paper from July 2026.
This is a great one.
It really is. It's by Redwan Al-Wakami and Jackie S.H. Lee. And the title alone tells a story. It's called A Seat at the Table, Turning AI Macroeconomic Views into Portfolios with a Factor Framework.
A bit of a mouthful, but very accurate.
Yeah, exactly. But we are going to discover exactly how massive institutional investors, so think massive state pension funds and endowments, are solving this ultimate trust issue with AI.
Right.
How do you use artificial intelligence to make these highly complex billion-dollar economic decisions without letting a black box blow up your life savings?
And I can tell you, every single investment board on the planet is wrestling with this right now.
I bet.
They all know they need to integrate AI. But when the conversation turns to actual implementation for the highest level strategic decisions, meaning, how the total pool of capital is divided across global equities, bonds, real estate, the boardroom usually goes dead quiet.
Okay, let's unpack this. The core premise Al-Wakami and Lee present is, well, it's brilliant in its boundaries. The AI gets a seat at the table, but it absolutely does not get the chairman's seat.
That is the key distinction.
But before we get into the mechanics of how that works, we really need to understand why we even need an AI at the investment table in the first place. We have to look at the massive bottleneck in how human committees currently operate.
Yeah, the authors call it the arithmetic of attention.
The arithmetic of attention. I love that phrase.
It's very fitting. Think about the traditional asset allocation process we have used for decades. A committee of highly educated, very experienced humans meets once a month, or maybe once a quarter.
Right.
And their goal is to set a view on the global economy. But to do that well, they have to digest an absolute fire hose of information.
And the paper notes there are over 150 distinct massive signals out there. We aren't just talking about reading the morning paper here.
Not at all.
We are talking about official time series data from governments, real-time market pricing, transcripts of central bank speeches.
Obscure manufacturing indices from overseas, you name it.
Exactly.
And human attention physically cannot scale to meet that volume. No matter how talented a human committee is or, how many analysts they hire, they can only ever sample that flow of information.
They just grab bits and pieces.
Right. They grab a few data points here, they read a few summaries there. They simply cannot read, retain, and synthesize all of it simultaneously. The result is that they are making the most consequential financial decisions based on a partial, fragmented picture.
And that bottleneck leads directly to the temptation to just automate the whole thing. If human brains max out, let the massive server farm read it all.
Which is tempting. But the financial industry has generally had two very flawed responses to this data overload.
Okay.
The first is just paralysis. They do nothing. They treat AI as a neat toy to write emails, and they stubbornly stick to the old human sampling method.
And the second.
The second response is what I would call a total robot takeover. The authors actually cite a 2026 proposal by Ang et al., which envisions an architecture where AI agents do everything.
Oh, wow.
Yeah, they generate the economic assumptions, they build the mathematical portfolios, they vote among themselves on a winner.
Wait.
And then they literally write the final memo for the board to sign.
They just hand the keys to the bus over to the machine and head to the back row.
Basically, yeah. But if we connect this to the bigger picture, fiduciary institutions, legally and ethically, cannot operate that way today.
Because of the liability.
Exactly. Accountability is a uniquely human trait. You cannot sue an algorithm if it miscalculates inflation and loses $1 billion.
That makes a lot of sense.
So Al-Wakami and Lee designed a middle path based on comparative advantage. Humans are unparalleled at accountability, understanding risk tolerance, and rendering ultimate judgment.
Right.
AI, on the other hand, is unparalleled at massive, unbiased reading and synthesis.
So if we are delegating the heavy reading to the AI, how do we structure it so it doesn't just, skim the headlines, hallucinate a trend, and take a wild guess?
That is the big challenge.
Because I was reading the AI setup in this paper, and it struck me as functioning like a highly paranoid, heavily structured legal team.
That is a great way to look at it.
Yeah, like you don't just hire one lawyer to do everything from finding the murder weapon to interviewing the witnesses to rendering the final verdict. You aggressively separate the duties to prevent bias from poisoning the chain.
Well, that separation of concerns is really the structural genius of their whole design. They call it an agent society, or a pipeline of agents.
Okay.
And it runs in 3 strict sequential waves. The very first wave consists of the harvesters.
The harvesters, got it.
There are 5 of these harvester agents. Their exclusive job is to collect data across 4 main themes. So that is growth, inflation, policy, and credit.
And the 5th one.
The 5th harvester is dedicated just to market positioning and sentiment data.
And crucially, these harvesters are mathematically forbidden from interpreting anything.
Yes.
They are just the paralegals fetching the raw documents. Like, if the monthly jobs report comes out, their only function is to log the hard numbers into a secured database. They cannot write a note saying, the labor market looks like it's weakening.
Precisely. Keeping interpretation out of the collection phase prevents the AI from deciding the story before all the evidence is even gathered.
That is so smart.
Once the raw data is safely harvested and audited for any missing pieces, it moves to the 2nd wave, the judges. And this is where it gets incredibly sophisticated.
Yeah, there are 20 judges in total, right?
Exactly. 20 judges. The creators applied 5 distinct analyst personas to each of those 4 economic themes we mentioned.
This part fascinated me. Instead of just asking one giant brain for an opinion, they designed 20 specialized bots that mimic the natural friction of a real investment floor.
Exactly. To understand why this matters, imagine a sudden spike in global oil prices.
Okay.
A hard data analyst persona demands strictly quantitative numbers to back up any narrative about how that affects growth.
Right.
But sitting next to them is a bottom-up analyst persona. They are scanning transcripts of shipping company earnings calls to see if executives are panicking.
Oh, that is clever.
You also have a sentiment analyst who is actively hunting for gaps between the hard numbers and the euphoria or fear in the news cycle. Then there is a global analyst looking at external demand shocks, and finally a generalist to maintain a broad view.
So they all look at the exact same raw evidence pack provided by the harvesters, but their distinct instructions force them to weigh that evidence differently.
Right.
And they completely memoryless, which is wild.
Memoryless agents are vital for objectivity here. I mean, human analysts suffer terribly from anchoring bias.
For sure.
If a human analyst makes a bold call that inflation is falling, and the next week's data contradicts them, their instinct is to defend their past prediction.
Naturally.
These AI judges receive no past reports. They wake up completely fresh every cycle, look only at the current data, and score the probability of different economic regimes.
Okay, let me make sure I follow the next step. After the 20 judges render their individual scorecards, the pipeline funnels into the final wave, which is the synthesizer.
Correct.
And this is just one single agent. Using our legal team analogy, this is the senior partner at the paranoid law firm.
Perfect analogy.
The synthesizer doesn't go back and rejudge the evidence. It simply consolidates the scores, averages out what the judges decided, and writes a highly defended commentary explaining the probability.
It brings it all together.
But there's a specific safeguard here that I want to try to unpack, the never a vote rule.
Oh, go for it. How do you read that mechanism?
Well, the system collects data on what the market already expects, right? Like the consensus of human forecasters, how traders are positioning their bets.
Yes.
But it seems like that consensus data is structurally quarantined. It's locked away from the voting booth. If the AI sees that everyone on Wall Street expects GDP to hit 2.5% and the actual data points to 2.5%, the AI doesn't register that as a bullish surprise. It's just already priced in.
You have captured the essence perfectly.
Yeah.
The crowd's opinion is used exclusively as a benchmark to measure what constitutes a surprise.
Interesting.
Furthermore, if a trade is highly crowded, that consensus data is used to actively cap the AI's conviction level.
Oh, I see.
But the critical distinction is that the crowd's belief never counts as actual evidence in the AI's internal probability math. Just because a trade is popular doesn't make it fundamentally true.
As incredibly organized as this sounds, I have to play devil's advocate here for a second.
Please do.
What stops the AI from just going rogue? Anyone who has used a language model knows they can hallucinate facts. What prevents this complex system from hallucinating a false data point, or even quietly rewriting its own rules to make its past predictions look more accurate?
Well, the authors anticipated that exact vulnerability. To prevent a rogue scenario, they implemented what they call the scope guard.
The scope guard.
Yeah, it establishes a hard boundary on the concept of self-improvement.
Because we do want the AI to be able to fix itself if minor things break, right? Like if a government website changes its formatting and the harvester gets a 404 error, we want the AI to rewrite its collection script to find the new link.
We do. The AI is fully permitted to fix its own operational plumbing. But under the scope guard, it is mathematically and structurally locked out of touching the analytical frame.
So it can't change the core rules.
Right. It cannot change the fundamental definition of an economic regime. It cannot alter the historical mapping of how inflation historically impacts the bond market.
That makes sense.
This raises an important question, though. Where does the actual determinism, the hard math, live in this system?
From the sounds of it, it doesn't live in the AI at all.
That is exactly the secret to the trust equation. The final calculations, the averaging of the judges, the mapping of probabilities to return factors, the Monte Carlo simulations, none of that runs inside the AI's language model.
Wow. Where does it run?
It runs in a pinned, fixed Python script.
Let's pause on Monte Carlo simulations for a second. For those who might not spend their days deep in statistical modeling, that basically means running thousands of simulated futures based on random variables to see all the possible ways a portfolio could break, right?
Exactly that. It is a stress testing playground. And because those stress tests and calculations happen outside the AI, in a hard-coded script, the determinism is absolute.
Meaning it's completely repeatable.
Yes. If you feed the exact same judge scorecards into that synthesizer script 1,000 times, you will get the exact same digit-for-digit mathematical output 1,000 times. The AI is only providing the text inputs. The traditional transparent math does the calculating.
And there is also the demand for falsifiability.
Right. Every single call the AI makes must ship with specific numerical triggers that would prove its thesis wrong.
So it can't just be vague.
No. If it predicts rising inflation, it has to state, if the core inflation report on July 28th comes in below the specific percentage, my thesis is validated. It forces the AI to be accountable to future reality.
Here's where it gets really interesting. Once this paranoid AI pipeline finishes its work, it generates a view of the economy.
Yes.
The paper defines this view as a probability vector they call pi, paired with a confidence dial they call gamma.
That's right.
But how does a probability actually buy an asset? Like, knowing there is a 60% chance of inflation doesn't tell a trader what to do.
Bridging that gap takes us to step 2, which is the deterministic engine. This is where the AI's abstract economic view is mathematically translated into a candidate portfolio.
Okay.
And note the word candidate. It's merely a suggestion for the human committee. The engine takes the AI's view, the pi and gamma, and uses it to tilt the institution's existing capital market assumptions, or CMA.
Let's define CMA real quick for the listener. A firm's capital market assumptions are basically their baseline expectations for how different assets will perform over the next decade.
Exactly.
It's the baseline reality the board has already agreed upon.
And the AI isn't allowed to invent a new reality. It is only allowed to tilt that agreed-upon baseline based on the fresh evidence it just analyzed.
Oh, I see.
And crucially, this translation engine runs against hard, immovable human limits. The chief investment officer, the chief risk officer, and the board of directors have already hard-coded strict minimum and maximum bands on every single asset class.
So there are guardrails.
Huge guardrails. If the human board says, we will hold no more than 50% in public equities, the engine mathematically cannot output a portfolio with 51% equities, no matter how confident the AI is.
To make that manageable, the authors include this highly practical feature, the 60/40 dial. I look at this like a mixing board in a music studio.
That's a good visual.
Instead of the chief investment officer having to manually adjust 500 individual equalizer sliders for every obscure asset class, they just grab the master volume dial. In this case, the master volume is the desired Sharpe ratio on a standard 60/40 stock and bond portfolio.
And the Sharpe ratio is simply a measure of return per unit of risk. It basically asks, for every bump of volatility I stomach, how much extra profit do I demand?
Right. So if the CIO feels a balanced portfolio should earn a 0.35 Sharpe ratio, they just type that number into the master dial.
Just one number.
Yeah. The deterministic engine then automatically adjusts all the underlying sliders, all the premium structures and risk targets to match that master setting. It translates a massively complex covariance matrix,
Which is just a giant statistical web mapping how every stock and bond moves in relation to everything else.
exactly into a language human executives actually speak. But wait, we have to talk about the no-view twin.
Oh, definitely.
When I read this part, I was genuinely surprised. The computer is essentially generating a control group for itself in real time.
It is. It is the most powerful governance tool in the entire framework. Every single time the engine generates a portfolio based on the AI's economic view, it generates an exact companion portfolio with the AI's brain completely switched off.
Wow.
The confidence dial, gamma, is manually set to 0.
So the human committee sits down at the table, and they have the portfolio with the AI's insight sitting right next to a portfolio without it, both subject to the exact same human constraints and risk targets.
It isolates the machine's influence down to the decimal point. If equities are up 2% in the AI portfolio compared to the no-view twin, the committee knows exactly what the machine is betting on.
There is no mystery at all.
None. It forces the AI to show its work in a comparative format.
Okay, all this theory is great, but to prove this isn't just theoretical math, the authors ran the engine against a real, messy economic reality. Let's walk through the real-world test from the paper June 28, 2026.
This is where the framework really proves its value. On that specific date, the AI pipeline analyzed the global data and calculated a 57% chance that economic growth would beat expectations.
But, and this is a massive but, it only gave that prediction a medium conviction rating. Gamma was set to 0.5 out of 1.0. Why the hesitation if growth looked good?
Well, the AI noticed conflicting signals. Even though manufacturing data was up, its sentiment and bottom-up judges noted that consumer data was softening.
Ah, okay.
Additionally, the positioning data showed the market was already heavily crowded with bullish bets. The crowd was already greedy, which triggered the system to cap its own conviction.
So, with a 57% probability and only a 0.5 conviction, what did the translation engine actually do to the money?
It was incredibly measured. The engine bumped public equities up 7 percentage points and dropped fixed income by 13.5 points.
Let me translate that. It funded the purchase of more stocks by selling off long-term bonds, which are highly sensitive to interest rate changes. The machine didn't panic, and it didn't manufacture certainty it didn't have. It just made a moderate, pro-growth tilt. But looking at that test made me wonder, what happens if you take that gamma dial, the AI's confidence, and you crank it all the way up to 1.0?
The maximum confidence.
Yeah. If the machine is absolutely, unequivocally certain that growth is exploding, does it sell all the bonds and buy every stock on the market?
It absolutely does not. The authors actually ran a confidence sweep, simulating what happens as you dial gamma from 0 up to 1.0. At first, the portfolio tilts grow smoothly. The more confident the AI gets, the more it buys.
Makes sense.
But around the time gamma hits 0.75, the portfolio simply stops changing.
The lines on the graph just hit a ceiling and go completely flat.
Because the human set risk bands and volatility targets exhaust the feasible set of options before the AI's conviction maxes out.
Oh, wow.
The AI might be internally screaming, "Buy more equities!" But the deterministic engine looks at the rules and says, "I mathematically cannot. We have hit the board's maximum risk limit."
So the human mandate binds the machine. No matter how sure the AI becomes, there is a maximum threshold it cannot cross.
Exactly right.
There is also a really cool practical nuance they tested, which is pinning the private book. Massive institutions hold a lot of illiquid assets, like commercial real estate, private equity.
Right.
You can't just sell an office building on a Tuesday afternoon because an AI algorithm told you to.
The framework accommodates that reality. It allows the institution to freeze those illiquid assets inside the engine.
You just pin them in place.
Pin them in place, exactly, which forces the AI to only express its economic views by trading highly liquid public markets around those frozen assets.
That is so practical.
It answers the actual question the committee faces. Given that we are stuck with this real estate for the next 5 years, how should we adjust our liquid stocks and bonds today to prepare for the economy that is coming?
So what does this all mean? The deeper we get into this paper, the more it feels like a total paradigm shift. Governance isn't just a thick policy document sitting on a shelf that you hope the algorithm follows.
No, not at all.
Governance is the literal mathematical boundary of the software. Constraints actually create the freedom to trust the system. Because the humans hard code the outer boundaries, they can let the AI run at full speed within the fenced-in yard, knowing with absolute mathematical certainty it can never jump the fence.
That is the core takeaway. The authors prove that you can harness the incomprehensible processing power of an AI without surrendering your fiduciary duty.
For you listening, whether you are managing a massive state pension fund or just trying to figure out how to integrate AI into your daily workflow, the lesson here is profound. Use AI to massively expand your synthesis.
Definitely.
Let it read the 150 data feeds. Let it gather the evidence and act as your paranoid law firm. But ensure you hard-code your personal boundaries, your risk tolerance, and your values into the final decision engine. Give AI a seat at the table, but never the chair.
The paper provides a phenomenal blueprint for doing exactly that.
Yeah.
But honestly, studying it leaves us with a fascinating philosophical and potentially legal puzzle that isn't explicitly answered in the text.
A puzzle. Okay, let me hear it.
Imagine a fiduciary board uses this exact framework for 5 years. Every quarter, they sit at the table, they look at the AI's candidate portfolio, and they compare it to the human committee's no-view twin.
Okay, I'm with you.
And let's say the historical data proves, definitively and undeniably, that the AI's candidate consistently outperforms the human committee's baseline with less volatility.
Oh, boy.
Does the human fiduciary duty eventually mandate handing the chair over to the machine? At what point does human intervention change from being a necessary safety mechanism to becoming a measurable liability?
Wow. If you are sitting in the driver's seat of that massive bus we talked about, and you know for a mathematical fact that the autopilot crashes far less often than you do, at what point is stubbornly keeping your hands on the wheel actually the reckless choice?
Exactly.
That as a heavy question, it's something you really have to mull over. Until next time.